All right, guys. In this second part of the inflation series for July, the producer price index came out, and for all commodities, it was another bad month for producer prices. So while Wall Street was cheering that consumer prices met their expectations in large part, actually, when you consider core CPI, actually fell a little bit below their expectations. Producer prices are still pointing to high inflation. So for all commodities, the month over month rate came out for producer prices, and I think it was about 1.2%. So it's been a little bit cooler than what we've been seeing in previous months, but that's been due to a fall in lumber prices that have been going on in the month of July, and it may continue in August. In August, actually, we might even see producer prices cool off on the all commodities index and on the front end a little bit more as we absorb the rest of those falling lumber prices. And so this inflation rate now that we've got in producer prices is the highest annual inflation rate that we have seen since the 1970s. It's just absolutely awful right now. And with final demand goods, it came out and it was horrible. It was a 1% increase. So now we're seeing this divergence develop between the consumer price index and the producer price index for final demand. Now remember what I've been telling you about how the two indices would often correlate very strongly with each other. Now they do divide off a little bit here, okay? So there've been times in the past when producer prices would fall for final demand and consumer prices wouldn't fall quite as much, or when they'd rise and consumer prices wouldn't rise quite as much. But now we're seeing the biggest divergence in history. So something's got to happen. Either the final demand is coming down, or consumer prices are going to jump up. And my guess is that they are going to jump up. Now, when they jump up, I think that they'll keep a little bit of this breadth, this variance between each other. But yeah, I do expect the consumer prices to jump. I don't expect them to calm down. So looks like what happened in July was an anomaly. We got a little bit of a breather, but the costs are now going to be passed down. They're coming down, and until we see a real calming down going on in the commodities index, this is not going to change, because what's going on in the front end for raw materials is going to go on to intermediate goods, then it goes on to final demand goods, then gets passed on to the consumer prices for retail goods. And although at different stages, companies employ whatever cost saving techniques they can absorb. In the end, most of this is going to be passed off to the consumer. And when you take a look at final demand compared to consumer prices right away, there's never been a time in history when the consumer price index has fallen below 98% of the final demand producer price index. So in other words, what gets passed off in cost increases to final demand, 98% at the minimum, 98% of those prices get passed on to the consumers. In some cases, the consumer price index actually exceeds that of final demand. But this has been the case since record keeping had been started way back in 2010 for final demand goods. So what's going to happen? Well, it's coming down the pipeline for consumer prices. So looking at my final demand CPI model, let me go over with you what I'm expecting with the incoming inflation rates for July. First off, let me recap on what happened for incoming inflation rates for August when they come out in September. But first, let me recap what happened with July. So here, we had the forecast going on that in both chains of forecast, I was forecasting that the year-over-year CPI inflation rate was going to reach up to 5.7%, which would translate into a monthly rate of an increase of 0.9. We didn't get that. Instead, we got a 0.5% increase. And so that led to an error rate of 0.4 to 0.5. Now, as I said in my previous vid, and I'll post the link in the description so you guys can get the full breadth of the review here, when I calculated this model to forecast the change, I should have noted here, and I did put it in, I mentioned it when I originally created it, but I didn't spend too much time on this. But this is plus or minus 5% year over year. So if I tell you that the inflation rate is looking like it's forecasting to be 5.7, that's plus or minus 5.5%. So down below, I've done things properly here, and I've sort of tabled out the low, medium, high. So I'm giving you my price forecast, and based off of final demand inflation, it's looking like that in the medium, that your prices are supposed to jump for the CPI by 1.3 to 1.4, and lead to a year-over-year increase of 6.3 to 6.4. But on the low end, at the minimum, we should be expecting a year-over-year inflation rate of 5.8 to 5.9, which is a monthly change of 0.8 to 0.9%. So that change that we were supposed to get in the previous month is going to hit us in this month. In the medium term, it's assuming that we're going to recover. It's basically the CPI is going to make up for what it lost in the previous month, so it's taking that into account. And then I'm giving you the high range in case if the CPI overshoots. Now, in that case, I've done something else. I've kind of color-coded this and given you my own instinctive probabilities of what I think is going to be the likely outcome of the CPI change that comes out for August's numbers in September. So in green, it's most likely. Yellow, it's kind of in the middle. And orange is not very likely. Okay, so right now what I'm thinking here is that we're probably going to end up more on the low end. And the reason why is just because, look at this monthly change is forecasting 0.8, 0.9%. I do expect it to go a little bit hotter than this, but I'm not sure if it's going to go as hot as to say we're going to get a monthly jump of 1.3 to 1.4%, especially with commodities beginning to cool down just a little bit on the front end of the producer price index thanks to falling lumber. I mean, certainly it can happen. But my guess is that we're probably going to end up closer to the low end. So year-over-year inflation should probably hit at around 6% on the CPI, so to say. Okay, I don't think it will get much higher than that, but it's definitely possible. So the model's definitely pointing to in the middle to hit at about 6.3 to 6.4. We'll see if that transpires. But definitely, I would say we're going to be hitting up to 6%, and that's going to push up here. So that being said, if you push out and you say, okay, well, let's just assume that to get that, we're going to get a 1% increase in the CPI. Charting it out looks like things are still in line for, a year-over-year inflation rate by the end of the year to be 7 to 8%. It looks like that's what's going to be hit. We're hitting just based off of the trend and also based off of producer price indices. Okay, so your producer price index is still pushing up. Yeah, it went up by 1.2, and that was a little cooler than the previous months. And excluding April, it was cooler since February, or really since January. We went back to December's levels. But again, looking at the average and the median, even if that comes down a little bit, we're still looking at an average CPI inflation rate of about 7.7% or so. So that's still really, really high, and I can't help but think that is going to be bearish for stocks in that manner and bullish for precious metals in the long run. But that being said, let me touch on that for a second. I think for the next couple of months, precious metals are not going to enter their bull market yet. I think the debt ceiling debate is going to put some kind of downward pressure, as well as expectations that the Fed might taper sooner than it anticipated, which is sort of like predicting future deflationary events. And, but on the other hand, bond interest rates are going to stay low. They might even drop a little bit. So that should theoretically be bullish for precious metals. But I think it's actually going to be bullish for stocks in that manner. Going back to the CPI analysis, though, just recapping here, based off the money supply jump, we've still got to see a minimum of 7% just to get back to norm in the relation between money supply and debt to the CPI. It doesn't necessarily have to happen this year, but if we did catch back up by the end of this year to the minimum, with a high confidence in the U.S. dollar, we've still got to see that 7%. So that sort of bolsters that CPI outlook that we're looking at a minimum of 7% inflation. Over here, I've sort of come out and let me correct this right quick. There we go. I've sort of tabled out what has been our annualized inflation rate for the CPI right now. So, it's been pushing up ever since January, okay? So early on in January, I knew that there was going to be problems that we were going to have an inflation rate just based off the annualized increases. And they've been building to June. Well, what happened in July? Well, they calmed down just a little bit. They calmed down to an annualized rate of 7%, but it looks like they're going to pick right back up in August and maintain like that throughout the end of the year. So I definitely think that that's going to be very bearish for traditional investments, and it's going to be alarming for economic growth as these costs start to eat into corporate profits and into real wages. One other thing about the core CPI right here is that the core CPI came in at a 0.3%. I'm still assuming though that we're going to get some high jumps in the core CPI that's going to push it closer to 7% by the end of the year. I don't see how we're going to miss that. Your long-term inflation, one of the things I've noted here is that your long-term inflation is still holding steady at around this 3% for the CPI when you count to the fact that we had a drop last year in inflation, or a relative drop in the growth rate of inflation due to the COVID pandemic and government shutdowns. But again, those 2-year inflation rates are going to start to build. So even if you discount and say that investors are taking into account the COVID situation, we're still going to hit those higher inflation rates in the coming months. And then this is going to wash away in 2022. And that's when real panic is going to start to set in. So as I said before in yesterday's video, I didn't see anything coming down the pipeline that was going to change my analysis. And pretty much the producer price index, especially for final demand, seems to reinforce my narrative that that what was going on with the CPI for this month is just a lull. It's going to jump back up in September, and that could potentially throw markets off and derail. Until then, I expect stocks to be in a bull market and push upward unless if we get some kind of bad economic news or something that comes down the pipeline. But that doesn't necessarily mean it will translate into a higher commodity price or higher precious metals price for gold and silver right away. In the long run, it definitely will, and this is going to stay for the long run despite the Fed narrative. So anyway, guys, thank you for watching this video. Let me know what you think. Please comment on the video. Let me know if you agree with me or disagree with me, just have a different take on matters, or if you think I'm spot on. Make sure you click that like button if you enjoyed it. Show me some support. Subscribe to my channel if you keep wanting to see videos like this. Make sure you click that notification bell so you're notified whenever I upload. And the next video that I'm going to make, I'm going to do a little bit of digging into why I think that despite the higher inflation rates, investors are still piling money into the stock market. Okay, that one's kind of. I mean, I've got some ideas on that, and true, and I've got some intuition, but I'm going to do some metric analysis there and see what's going on that, as far as why they're just piling in and not driving into the precious metals department right away, and when we might see that trend could reverse. Okay, so just be on the lookout for that. I don't know if I'm going to release that tomorrow night. It may be Saturday. It probably will be Saturday, but it's definitely going to. I'll make sure to push that out in the next couple of days. So stay tuned for that, and until then, I'll talk to you later.